question, I believe they're going to destroy the dollar. I think that's what they're intending to do to save the system. How do they do that? I think ultimately you see the stablecoin bill that is being used to flood the front end of the bond market with short-term debt issuance, which when Janet Yellen did it, we saw how beneficial that was for metals and for equities and for cryptocurrencies. And as Luke Groman, I think aptly puts it, they want to anesthetize the back end of the market. And here is the thing. When you look at where we're at the back end of the market, the 10-year treasury, you're going to see rates continue to move higher because just bottling up a few facts, we have $28 trillion due in 3 years in maturing treasury. That's fact. 28 trillion by 2028. We take in 5 trillion a year in tax revenue. That's 15 trillion. You're halfway there. That doesn't take into account the 3 trillion plus per year in deficit spending. They just came out with their projection for the next quarter. They want to print $1 trillion over 3 months. So the point of it is that 3 trillion per year deficit spending minimum over the next 3 years is another 9 trillion, 28 and 9, 37. We take in 15 trillion in tax revenue. We're, hardly 25% of the way there basically. So how do you do that? How do you finance that at a time when the rest of the world is shedding treasuries like China and Japan and Saudi Arabia? And now we're supposed to believe that the United Kingdom, one of the most indebted nations in the world, is buying the debt of the most indebted nation of the world. They're number 2, and the Cayman Islands and Ireland. The whole thing is a shell game. So what I believe that they are going to do is, first and foremost, let's look at, we've become a net importer of gold. And month over month, we're seeing massive inflows of gold every single month. I asked Judy Shelton, who was Trump's nominee to run the Fed in 2016, do you think that they're going to issue gold-backed treasuries? That was what her book was all about. On my interview with her, she said there is no question, in no uncertain terms did he say to me, July 4th, 2026, he will do that. It's a big day for him. It's the 250th year anniversary of the country, and he will issue gold-backed treasuries on the back end of the market that day. Now think about this. If you are reshoring all the gold, you let the price rise. Even Luke Groman thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called valuation. You can't make it up. That's the name of it. If they did revalue, first of all, it would benefit every central bank on the planet. The Treasury only needs to tell the Federal Reserve, revalue the price of gold right now. And they do. Bang, it's done. No congressional approval. Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. If they moved it, as Jim Rickards says, to $24,000 an ounce, as crazy as that sounds, it would benefit all the central banks. It would massively devalue the dollar, to your point, create tons of inflation, but now that would give the Treasury general account $6 trillion free and clear. The Treasury issues gold certificates to the Federal Reserve. The Federal Reserve takes the gold and holds it. Prints the money, the $6 trillion, which devalues the dollar tremendously, just like Roosevelt did in '33, gives the money to the Treasury. Now the Fed doesn't own that gold, they own the dollar value of the gold. The gold belongs to the Treasury and to the American people. Now they start paying down their debt. They don't have to issue any long-term treasury. They flood the market with stablecoin issuance on all the cryptos that fund the short-term treasury debt to keep the game going. And with low interest rates, if you back the treasury, the long end, like the 50-year to start with, as Judy says, and then 30 and 20 and 10 later, shorter durations over time, you can peg a zero interest rate to the long end of the curve. Zero interest rate, zero coupon, redeemable in gold. That gold is the inflation barometer. The more stupidity we use in monetary policy, the higher the price of gold goes. So we say, take our long-term treasury. You can still trade it the way you always do, giving you great liquidity, but it is redeemable in the end in gold. Judy Shelton says they'll issue stable coins off of those too, giving more energy to the short front end of the curve. And now you have zero interest rates on the long end, redeemable in gold way down the road, starting at 50, 30, and then 20 and 10 over time. But now you can bring back your manufacturing in an era of a very devalued dollar and very low interest rates on the long end. Bring back your manufacturing, reshore your manufacturing, and grow your way out of this mess that we find ourselves in. It is, in my mind, the only way out. You can hyperinflate, you can default, or you can do a soft default on the dollar, which I think they're going to do. They're going to destroy it. You save in dollars, you're going to go broke, period. So they will print their way out of this problem to print the $37 trillion in debt in 3 years, but they will peg the Treasury to gold, probably revalue it, which devalues the dollar, allows them to pay off the debt, some of it, and not issue long-term debt for a couple of years anyway, with all the money they take in from the Fed on the Treasury General Account issuance of gold certificates, with those low interest rates and cheap dollar, you bring back your manufacturing, you retool, and you grow your way out of this problem. And I could see Trump getting in front of the American public and saying, listen, we've squandered this wonderful opportunity. And by the way, they understand it. It's called Triffin's Dilemma. Vice President Vance has talked about this, written about it on White House letterhead, that if you are the world reserve currency, Triffin's Dilemma says you will always have a trade imbalance, a big one, because you cannot give the world enough dollars to do everything they need to do with the world reserve currency simply by trade alone. You export dollars to the rest of the world, which means they sell their currency to buy your currency. Their currency goes down, your dollar goes up, meaning manufacturing over there is half the price, let alone the labor side. So your manufacturing gets hollowed out. There is no way to be a world reserve without hollowed out manufacturing. So all the manufacturing goes over there, and that's where we are now. Coupled with the indebtedness and the fact that we've held interest rates so low for so long, so many years, that we created distortions in asset prices, there is no way to bring it back without blowing up the entire system. Either you hyperinflate or you let rates go to the moon in stocks, bonds, real estate, banks, insurance companies, poof, all at once. So how do you keep rates low in an inflationary environment and still get demand for the long end of the curve? The short end, they will create these stable coins, which is really not stable if you think about it. A coin that is backed by debt and more coins and more debt and more coins. And it's a shell game on the front end for a while. But if we have the ability to drop rates down to zero because of redeemability in gold and bring it back, you have a fighting chance to grow your way out of this problem. You truly do. Inflation will not be solved by letting rates go higher. You'll destroy the system. Inflation would only be resolved in this environment by growing your way out. And we ain't gonna do that until we bring back our manufacturing. And we ain't gonna bring back manufacturing at 5, 6, 7, 8, 9% interest rates. At zero and a very devalued dollar, yeah, you could. Honest to God, I believe that's what the plan is. So yeah, you save in dollars, you're destined to go broke. You're not a contrarian, you're gonna be a victim. And that I do believe, 100%.
It's no longer a question of if they're going to destroy the dollar. It's when, and more importantly, how. I believe with absolute conviction that the powers that be intend to destroy the dollar in order to save the system. It sounds paradoxical, doesn't it? To burn down the house in order to save it. But that's what's happening right in front of us. And if you're sitting there saving in dollars, you're setting yourself up to be a victim, not a contrarian. You're holding on to something they're deliberately eroding, systematically dismantling, while the insiders, the people closest to the information, are sprinting for the exits and into tangible assets like gold and silver. Let's start with this stablecoin bill. I want you to understand why it matters. Stablecoins are marketed as the shiny new toy for crypto adoption, a digital dollar on the blockchain. But peel back the curtain and you realize they're being used as a weapon to flood the front end of the bond market with short-term treasury issuance. Think about that for a second. Janet Yellen did exactly this, and what happened? Precious metals rallied, equities rallied, even cryptos caught a bid. Luke Gromen puts it brilliantly. The goal is to anesthetize the back end of the treasury market. In plain English, to dull the pain, to mask the dysfunction. They're plugging leaks in the system with new leaks, shifting the weight around instead of solving the problem. Here's the kicker. By 2028, $28 trillion in treasuries are maturing. That's not a conspiracy theory. That's arithmetic. $28 trillion coming due in 3 years. Now add $3 trillion per year in deficit spending. That's another $9 trillion, which brings us to $37 trillion that needs to be financed in 3 years. And what do we take in? In tax revenue, about $5 trillion per year, so $15 trillion against $37 trillion in obligations. That's a shortfall that makes the Grand Canyon look like a pothole. How do you finance that when the rest of the world is no longer buying your treasuries? China's selling, Japan's selling, Saudi Arabia's selling. So who's left? Are we supposed to believe the United Kingdom, one of the most indebted countries in the world, is stepping up to buy the debt of the most indebted country in the world? Or that the Cayman Islands and Ireland are heroically supporting the US bond market? Come on, it's a shell game. It's smoke and mirrors. So what's the plan? I think the breadcrumbs have been there for us all along, if you've been paying attention. Since November, we've become net importers of gold. That's not coincidence. That's strategy. Every month, massive inflows into COMEX. Every month, draining of the LBMA. Every month, insiders pulling billions worth of physical off the exchanges. And at the same time, you've got rhetoric from Donald Trump himself. Easter Sunday, remember that tweet? He who has the gold makes the rules. That's not just a throwaway line. That's a signal. That's the golden art of negotiating. Treasury Secretary Mnuchin, Judy Shelton, all of them have been dropping breadcrumbs for years. And now we're watching the policy machinery line up exactly with what they've been hinting at. Let me connect this dot for you. I had Judy Shelton, Trump's nominee to run the Fed, on an interview. I asked her point blank, "Do you think they'll issue gold-backed treasuries?" She didn't flinch. She said in no uncertain terms, yes, July 4th, 2026. Why that day? Because it's the 250th anniversary of the United States. Can you imagine Trump standing on that podium, fireworks show behind him, and announcing to the American people, "We are issuing gold-backed treasuries to restore strength to the dollar, to restore faith in America"? You think he wouldn't do that? You think he wouldn't love that symbolism? It's political theater and monetary reset rolled into one. And by the way, that's not me speculating anymore. The Federal Reserve itself just published a paper on gold revaluation. Go read it. It's right there on their website. What used to be a fringe theory is now officially part of the conversation.
And look, we've become net importers of gold since November. And, there's no coincidence that's when he won the election. The amount of interest that we've seen on all levels, precious metals, since November, and the crumbs that have been left along the way from people such as Donald Trump himself, Treasury Secretary Bessent, Judy Shelton. I mean, on Easter Sunday, Trump says by tweet, "He who has the gold makes the rules," the golden art of negotiating. That comes after massive imports since November. In 35 years, I've never seen that, ever, never. Maybe 1 month here, 1 month there, but now month over month, we're seeing massive inflows into the COMEX. We're seeing the draining of the exchanges and the LBMA and the COMEX. And then you're seeing all sorts of rhetoric that would lead one to believe that things are different this time. But the interesting thing about it, when you take a step back and you look at the macro picture, Steve, what you see is something that I think really screams to the contrarian in me. And that is that since the beginning of the year, we've seen massive selling in equity by the insiders, the institutionals, the insiders. We just saw Jeff Bezos sell another $5.7 billion in Amazon stock. You got Warren Buffett sitting on $500 billion in cash and treasuries. You have Jamie Dimon selling. You have Zuckerberg selling. You have all of the insiders selling. Since June, the institutionals have been selling on average $2 billion per week. You had the top 3 largest shareholders and board members of NVIDIA dumping hundreds of millions worth of stock. Now, this is at a time when the insiders are all leaving and the retail public, the mom and pop, have a larger exposure to the equity market than ever before, ever, including higher than the dot-com bubble at about 53, 54% of all stock ownership is owned by the retail public. At the same time, you're seeing the public really not have much exposure at all to metals on this level. And in fact, Rick Rule often says 1/2 of 1%. That's probably being generous. While you're seeing the exchanges being bled dry. Now, to take possession of what amounts to, or to have delivered at what amounts to over $100 billion in gold and silver, $100 billion since the beginning of the year that we know of. A lot of central banks are now admitting to buying privately from local and artisanal miners, not doing it through the normal channels that would get cataloged, like through the COMEX or through import-export numbers coming out of London or Switzerland, but that we know of $100 billion. So the insiders are going deep, deep, deep into physical commodities and actually taking possession, pulling them off of the exchanges while the public is going the opposite direction. So you have massive influx in metals by the insiders and leaving the equities by the insiders. It's the polar opposite by the retail public. What could possibly go wrong? Yeah, I think you're looking at a setup for a very big second half of the year, and I would expect the fall to, show that. The insiders don't take possession in May of $8.5 billion in gold off of COMEX. This is 1 month that we know of, without it being something that they've given a lot of thought to and probably know the playbook, because at that level, those people just don't have the most money. But to take possession of that kind of or even just to deliver that kind of volume into COMEX is incredibly sophisticated, and it's not something easy to do. You'd be far easier for someone to give me $500 million and have me go out and scour the world and get them gold bars and stuff than it would be to take possession of metal.
Now let's walk through how this plays out in real time. Gold revaluation isn't a fantasy, it's a playbook. Roosevelt did it in 1933 when he took gold from $20 to $35 overnight, a 70% devaluation of the dollar against gold. That was the equivalent of a massive wealth transfer. And here's the dirty little secret: the same mechanism exists today. Gold sits on the Federal Reserve's balance sheet marked to valuation. It's not some fringe theory, it's literally how the books are kept. All it takes is one stroke of a pen, one announcement, and suddenly the price of gold isn't $3,500. It's $7,500, or $10,000, or $24,000. Every $4,000 increment adds $1 trillion to the Treasury General account. That's the war chest they need to paper over the next crisis. But here's where it gets even more interesting. This isn't just about the US. Every central bank on the planet would benefit from a gold revaluation because they all hold gold as reserves. Russia, China, India, Turkey, Saudi Arabia. They've all been hoarding gold quietly, some openly, some through backdoor channels. China's imports through Hong Kong and Switzerland have been off the charts. Russia is now rolling out a gold exchange in St. Petersburg. Petersburg, setting benchmarks independent of London and New York. The BRICS are building parallel systems. And when you add all of that together, you realize the West's suppression of the gold price through paper contracts has been weaponized against it. China, in particular, has mastered the art of shorting paper in the West to buy physical in the East. They're turning the West's own rigging mechanism into a fire sale. Now think about the geopolitical timing. BRICS Plus has already launched its contingent reserve arrangement. They're trading more and more in local currencies. Saudi Arabia has joined. The petrodollar, the linchpin of dollar hegemony since the 1970s, is crumbling. And into that vacuum comes gold. You don't need a fully gold-backed currency to dethrone the dollar. You just need to reference gold as a settlement anchor, a partial peg, a clearing mechanism, a credibility booster. And that's exactly where this is headed. People laugh when I say $10,000 or $24,000 gold. They laughed when Bitcoin was $300. They laughed when silver was $5. But here's the math. If you want to cover $37 trillion in refinancing and you've got 260 million ounces of official gold reserves, you need a price closer to $15,000 to $20,000 to make the numbers work. That's not a fantasy, that's balance sheet reality. Even the Bank of America's own analysts are saying central banks will be forced to revalue gold because of debt burdens. Francisco Blanch said outright, "A revaluation would show gold isn't a barbarous relic, but a key monetary asset." That's Bank of America, not some gold bug on Twitter. And speaking of Twitter, look at what's trending in the corners of financial Twitter that matter. You've got accounts like at Luke Groman talking about the anesthetization of the back end of the bond market. You've got at Tabby Costa charting central bank gold purchases at record levels. You've got guys like at King Kong Macro pointing out how China suppresses Western paper to buy Eastern physical. These aren't random hot takes. These are breadcrumbs from some of the sharpest minds in finance, and they all point in the same direction. The era of dollar dominance is over. The era of gold as the neutral reserve asset is back. Now let's pivot to silver, because silver is the stealth missile in this story. Gold gets the headlines. Gold is the reserve asset. Gold is the chess piece of central banks. But silver is the asymmetry. Silver is the thing the public can still buy, the thing the system cannot suppress forever, because its supply-demand fundamentals are insane. 2 years ago, silver was $18. Today it's double that, and it's still undervalued. Why? Because silver isn't just monetary, it's industrial. Solar panels, EVs, electronics, medical technology. Silver is irreplaceable, and demand is exploding. At the same time, the mining supply is constrained. We're in structural deficit. That's why you're seeing deliveries on COMEX in silver too. Not just gold. Not as headline-grabbing, but just as significant. When Russia and China are accumulating silver as a strategic asset, not just an industrial input, you should pay attention. Because silver is money, always has been, always will be. Here's what people forget. Silver trades as a foreign exchange cross. It's not just another commodity, it's a monetary asset, priced against the dollar, the euro, the yen. It's deliverable FX. Basel III may not have blessed it yet, but the market knows. And when you see silver starting to set physical prices independent of paper suppression, you're watching the birth of a parallel system. That's why we're seeing premiums and backwashing into the global fix. That's why refiners and producers are pushing back against forced hedging. The physical market is starting to assert itself. And when that happens, the leverage of 100 to 1 or 500 to 1 paper to physical becomes a joke. It only takes one short squeeze, one failure to deliver, and the entire illusion collapses. That's the asymmetry. That's the opportunity. Silver doesn't need to go to $10,000 to change lives. It just needs to revert to historical ratios. Gold at $10,000 means silver at $500 if the ratio normalizes. That's asymmetric wealth transfer. But let's zoom back out, because this isn't just about metals. It's about the broader collapse of faith. David Morgan talks about it as a question of faith. Where do you put your trust? In God? In community? Or in the false idol of fiat money? For decades, we've put our faith in the wrong God. The God of paper promises, the God of central banks. And now that faith is collapsing. When you look at retail participation in equities at all-time highs, margin debt at all-time highs, options speculation at all-time highs, while insiders are dumping stock and hoarding physical metal, what you're watching is a transfer of faith. The insiders no longer believe in the paper casino. They believe in tangible assets. The public still believes in the fairy tale of stocks only go up. And as always, the herd will be led to slaughter. And let's not forget the propaganda machine. The mainstream media won't tell you this. They can't. Their job is to keep the public anesthetized, to keep them buying ETFs, chasing IPOs, gambling on options. They won't tell you about record outflows from COMEX. They won't tell you about central banks buying directly from artisanal miners in Africa and South America. They won't tell you about Russia launching a gold exchange independent of London. They won't tell you about Judy Shelton confirming gold-backed treasuries. But the information is out there, if you're willing to look beyond the surface. So what does the second half of 2025 look like? I think we're going to see fireworks. Insiders don't take possession of billions worth of gold and silver in May without a plan. They're positioning for something. And when retail finally wakes up, always too late, you're going to see a scramble into metals like you've never seen before. Premiums will explode. Supply will evaporate. Delivery times will stretch from weeks to months. And people will say, but gold was $3,500 last year. How is it $7,500 now? And the answer will be, because the dollar was destroyed to save the system and you weren't paying attention. I'll wrap this with a reminder of the art of war. Misdirection is the name of the game. They want you focused on the shiny object, on NVIDIA's next chip, on Taylor Swift's tour-boosting GDP, on the Fed's dot plot, while they quietly reposition the system. Don't follow the herd. Don't save in dollars. Don't believe the narrative. Watch the actions. Follow the insiders. And for God's sake, own physical gold and silver. Because when Trump steps on that podium in July 2026 and announces gold-backed treasuries, the herd will panic. But you will smile because you saw it coming.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.